Hey, good morning, everyone. Welcome to the macro snapshot for Wednesday, January the 21st, 2026. Okay, I want to start off by looking at volatility because we had a significant ramping up in volatility yesterday. Obviously, the markets were pretty active. And just to put this into context, this is what the difference between the day before yesterday. So you see that the front of the volatility curve. So this is like the VIX future. So you have spot VIX, and then you have the VIX futures, each sort of dot here. And in an ordinary situation, the front of the curve is trading at a lower level of volatility compared to further out in time. And that's the market essentially signaling the fact that, hey, things are not too bad at the moment. Things are relatively stable. We don't need a huge amount of sort of put insurance, for example. So we'll keep the volatility at the front of the curve lower. But you can see yesterday, and so that's the normal shape of the curve is a contango, where the front volatility is lower than the further out calendar months. However, yesterday we did see a sharp acceleration at the front of the curve, and you see the front of the curve flipped up into a slightly backwardated state. So suddenly we went from a sort of a front spot price of just over 16.5 in the VIX over 20, which is obviously indicating that the market is essentially saying, hey, we need a bit more sort of put protection. There's a little bit more fear, so to speak, or more volatility in the market, and that flips up. Now, what's the problem there? The problem is that a lot of sort of a systematic funds, so-called vol targeting funds, and a lot of CTA, so trend followers, a lot, and just general sort of systematic sort of hedge funds and whatever in the market, players in the market, as soon as volatility spikes, all of their quantitative models automatically tell them to sort of degross, to deleverage, and essentially to take down the risk, the value at risk, and the sizing, which automatically normally leads to some selling, not only in the equity space but also in bond space, and basically across everything, but especially in those more sensitive sort of equity and bond spaces. The other thing I just want to have a look at here is just the relationship between bond yields and equities. Now we know that the bond yields went up yesterday, so the equities, so the bond prices were falling, and also equities. The issue here to keep in mind is that the equity market in general, historically, it is if there is strong growth and a little bit of underlying inflation, 2.5, 2.75, maybe even up to 3%, if the medium and long-term bond yields go up in an orderly and measured pace, that is not necessarily a problem for the equity market, because the equity market looks at those rising longer-term interest rates and says, hey, yes, there's a little bit of inflation, but it's kind of healthy inflation because the job market is good, because the company earnings are good, the economy is expanding. So we're okay with that. And in that sort of healthy inflation environment, low inflation environment with a slowly rising yield and yield curve, equities can do okay. But what the equity market does not like are disorderly jumps in the long-term bond market yields. And we had that disorderly jump in the Japanese space, but also that pushed over into European bonds and also into US bonds. And just to put this into context here, what I have here is the volatility of the TLT. So that's a popular ETF which tracks, the 20-year bond, 20 to 30-year bond. And you can see here a huge spike yesterday. This is a daily chart. You can see a huge spike yesterday in the volatility of the TLT. Now, what I want to do here is to overlay that with something like, let's just put it on the ES futures, for example, or maybe we'll put on the SPY. We'll put on the ES, the futures, which is on the futures here. Let me just bring it up. So, yeah. So what I want to show here, you can see, and what I'm going to do is to invert the volatility. And you can see that these guys are very, very, very correlated, perfectly correlated almost. So basically what we have here is the ES in the dark blue. Oh no, sorry, I've done the wrong thing here. What I'm going to do, the ES. That's this wrong one. So there we go. Right. Okay. So what you can see here is that the ES, the equity futures are in the dark blue. A big fall yesterday, but you can see that coincides, and I've inverted the volatility of the TLT. So that's actually when this pale blue going down is actually going up. You see, it's going up in value. So the point here is what we can see is that anytime the volatility of the bonds goes up, that is very, very bad for equity. So just keep an eye on that. So that's the VXTLT. But also we can have a look at, let's say, the VIX. You can see a similar situation here with the VIX. Also, I want to look at the MOVE index, which is the bond volatility index, and you can see that that also moved. So the point here is that what we need to see in order for the equities to have a significant bounce again and just to calm down is basically the volatility indices, all of them. So sort of something like the VIX. We also need to look at the VIX curve. That needs to go back down into a flattening, sort of more contango sort of shape, but also keep an eye on the volatility indices for the bond market. Okay, so we'll leave it there just for the moment. So that's the important thing. So then the question, of course, is, well, okay, what is actually happening with the bond market? So we'll look at the MOVE index, and I'm just going to put that back onto the candles here. So you can see here that the MOVE index, hold on, let me there. So you see that that is still relatively elevated. So that's not great. And if we look at the VIX, you can see that it did come down a little bit yesterday, but overnight was still at over a 20 handle, which is starting to get a little bit, well, there's quite a lot of volatility. So the point is here is that we probably need to close this gap on the VIX. You see here we gapped up over the weekend from about 15 or 16 handle up to over 20. And although we had a little bit of calming yesterday, it's still up there. So that to me indicates that until and unless we can close this gap, or at least for this to get back down to 18, 17, 16, that's going to be a problem for equities to continue rallying. So let's have a look at the equities here. And we can see that, we had the gap down yesterday and they're continuing to fall. So as we speak this morning, down about 9 basis points, not a huge amount. We had Netflix earnings overnight, which were, generally better than the market had expected, than analysts had expected. But there are some concerns that Netflix is having to borrow quite heavily to fund its takeover of Warner Brothers. So that's a little bit of an issue, and there's going to be some sort of short-term hits to the cash flow there for Netflix. So that's a part of the problem here. But the broad problem for the ES you see down here, but also you see the Nasdaq falling hard. You also see the Russell not as bad. You see the Russell, the small caps did fall, but less bad. So it's really the big indices which are not doing great. We could see here, if you look at the Mag 7, down at a key level, getting down towards the 62.70. So that's a pretty key level here, which is going to be an interesting one. You also see the RSP equal weight also sort of gapping down, but holding in a little bit better. So, some of those smaller caps and the Russell holding it a little bit better. In terms of the technical levels, I indicated yesterday, I'm just going to put on some sort of moving averages here as well. We can see here that we've broken through the 50. We're now going down towards the 100-day EMA. So that's that sort of general zone, which is the 100 EMA is around about 6,800, which coincides with this sort of relative recent low at about 67.75. So that to me is really sort of a pretty key level here. And as you can see, we've broken this sort of recent uptrend. We've also broken this sort of pattern of buying the Fibonacci retracement. So if we now start looking at some of the longer term fib levels, we can see here we're going to have to anchor off this one of the 21st of November. And you can see on the chart here that we're now at about the 50% fib retrace. So it needs to hold here. And I would say we're starting to get to relatively critical levels here, because this around about the 50% retrace, which, as I say, is broadly coinciding with the 100-day EMA on the ES futures, which is, just above this recent high. So we're getting into a cluster of levels here, and a confluence of sort of technicals where the bulls should hopefully need to sort of come in. Well, hopefully they need to come in and, to support the market. If that doesn't happen and we get a break of the 50% fib retrace of the 100-day EMA and this local recent low there at 67.75, you've got to say that the next step down is probably to the 68% retrace here, 61.8% fib retrace at about 67.50. And then if that doesn't hold, that's not going to look good, because then we're going to pump all the way down to this, become like a triple bottom horizontal support, which also will coincide with the 200-day EMA at about 6,600. So a pretty critical day or two and a few levels coming up. Let's see if it holds there. Similar kind of price action over in the Nasdaq. I won't go through all the details, but just keep an eye here. You see we're at that 100-day EMA again. The fib levels as well, which I might just put on just to show you where those fib levels are here. So you can see, depending where you are on the 50% on the most recent impulse. So that's pretty important. So let's just step back as well and just see what's happening. And this is a confluence of sort of global yields, bond yields, and I would say also just have a look at the bigger picture, which is not necessarily something you trade on day to day. But let's just have a look at and see some of this stuff and just see where we're at. So we looked at the spike in volatility. But really, if we just want to look at the bigger picture, and I talked about this a little bit yesterday, but hopefully we'll yeah, so just bring that up. So again, we looked at the Japanese bonds and the fact that that there was there's going to be a sort of a snap election on February the 8th. Takaichi, the prime minister, has called that in Japan. She also, what was the immediate short-term catalyst for this was the fact that she said, hey, maybe we can get rid of some of those sales taxes, specifically on food, which is like 8, 9, 10%. So the bond market freaked out and said, hey, not only does Japan have a sort of a fiscal problem, its debt to GDP ratio is way too big. Now the incumbent government is starting to give away election goodies to try and sort of do well in the election, and suddenly we're not going to have a sort of a fiscally responsible situation, and that's the problem. So the fiscal factor is a big deal. So we saw in Japan here, you can see all of those long-term sort of rates going up, but as we see here, it's not only Japan, it's globally. It's basically most sort of bond markets around the world. And you can see the 10, 20-year forwards, which is a better sort of a read on where the bond market thinks, yields will be sort of, in the medium term, so to speak. And you can see that basically, US, Germany, Japan, UK, Italy, France, everywhere is up. The only outlier here, there's a few countries. So you have like sort of Sweden, Norway, New Zealand with relatively strong sort of balance sheets. So those countries are doing well. And you can see here that the green one, of course, is our friend from Switzerland. And you can see here it's a big outlier. The Swiss fiscal situation here, the 10-year, 20-year forward government bond yields in percentage is very low compared to everyone else, almost everyone else. And that's no surprise that the Swiss franc is doing well. So if we continue with just some of these charts, just showing us, broadly speaking, what's happening, you can also see that this concern about sort of too much debt all over the world, you can see what's happened in precious metals. And to index this back to the important Jackson Hole speech last August of Jerome Powell, where he basically said, the Fed's kind of okay with running the economy hot, is okay with having slightly higher in inflation. And you can see we've seen what's happened with like gold ripping higher, silver, platinum, everything. But look at the US dollar here, absolutely flat as a pancake and actually pretty weak. And so all of the precious metals is telling us that this sort of debasement kind of trade is real. I mean, we haven't seen Bitcoin, for example. And again, if you look at just getting back into some of the currencies, you can see here, again, going back, indexing this back to the Jackson Hole speech, you can see here that the countries with strong fiscal balance sheets, so fiscally prudent, are doing really well. So you can see, obviously, the Japanese yen is down against the US dollar. We've spoken a lot about the yen and the problems they have. And you can see here that, for example, the Swiss franc in the black is doing well. You can see the Swedish currency is doing very, very well. It's been helped a little bit by defense. It has a lot of defense contractors. But the point is that the Swedish ratio of GDP, of debt to GDP, is very good. Same thing in Norway in the yellow, and the euro doing okay, but not nearly as well as some of these other currencies. So that's really what's been going on. And just finally, just to have a quick look here. You say, well, okay, the US dollar is weakening against some of the G10 currencies, but the point is that it's also weakening against emerging markets, and that's interesting. So if you see here against in the black against all the G10, it has weakened and then now it's kind of stabilizing. But what you'll notice in the blue is that against emerging markets, you just look at a chart of, for example, the Mexican peso, South African rand, or the Brazilian real. A lot of these emerging markets, the US dollar is actually weakening a lot. And I showed yesterday the fact that local currency bonds, or let's say bonds denominated in local currency, but also denominated in US dollars in emerging markets are doing super well. So overall, what the markets, the big picture is telling us that countries which are not being fiscally responsible. So, for example, the US, the Great British Pound, the GB, the pound, and also the Japanese yen. So just look at the Japanese yen here. they're starting to decouple from yield. So the point I'm trying to make here is that there's big tectonic plates moving. And just look at this as an example here. You've got the yen in the black weakening on a trade weighted basis. So literally a balanced for compared, taking into consideration the amount of trade volume with specific trading partners and over all of the G10 currencies. You can see how weak that is. But on the other hand, you see that here that the 30-year rate differential with those same G10 trading partners is ripping a lot higher. So we have this kind of jaws separating. Normally, these should be correlated. The idea is that, hey, if you're trading, if your yields are going up and you have a healthy fiscal situation, normally, ordinarily, one's currency would also sort of strengthen. But that is not happening. And if we actually looked at the price action yesterday, what I want to show here is what seems to be happening is that the market is really not focusing so much on yields per se. It's focusing on fiscal health. The fiscal factor is paramount. So if we look at some of the FX majors here, we saw that the dollar is weak. It's had a little bit of a bounce off its fib here, but it was basically weak. And you can just compare that. You see that the Eurozone situation was much better. But look at the Swiss franc, very, very strong performance. This is the US dollar falling against the Swiss franc. Look at the pound yesterday. The pound really didn't gain that much against the dollar, and even it's down against the dollar. So the dollar, we remember the Liz Truss moment of 2022, where again she essentially tried to bring in a sort of a spending programs which were not funded. So what we're seeing is that the US dollar, the British pound, and obviously our friend over in Japan, the Japanese yen, is just not gaining even when everyone else is gaining. So, and what we saw yesterday, for example, is something like the New Zealand dollar. Look at this, New Zealand dollar ripping higher. Why is that? Is that because the New Zealand economy is amazing? No, not really. It's because the New Zealand fiscal situation is quite prudent. The relationship of their debt level to the GDP is quite low. Similar kind of situation, which I want to show you, is just what's happening in sorry, just give me a second here. I'm going to bring in the FX. If we look at something like the Swedish krona, you can see, look how strong it is. US dollar absolutely collapsing through this key level here of the Swedish krona, because again, the debt level is very low. And if you look at something like some of these cross pairs, you can see the euro versus is very weak against the Swiss franc. You can see the pound, let's say, the pound versus the Swiss franc is doing very poorly. So what I'm trying to say, everyone trading FX and equity. So if you're trading the equities, you need to be looking at the overall level of the yields and the speed of the yields and the volatility in the bond market. That's very, very important. But for FX, not only do you need to be looking at the nominal yields, like the level of the yields, you also need to be looking at how the market is perceiving the level of the yield compared to the debt situation. And again, just to repeat, countries which are perceived to be lacking fiscal discipline, are spending too much, have basically too much debt, such as the United States, such as Japan, and a little bit more in the past in Europe, they are really suffering on a comparative basis compared to countries with a fiscally sustainable path forward, such as Sweden, such as New Zealand, such as Switzerland, of course. So that's really sort of the big tectonic plates which are happening. Now, I just want to look at a few other markets here, guys. I don't want to go on too long, so let's just go back to a couple of other markets here. So we spoke about the equities. Let's just have a look at oil. Oil having a relatively good performance. I signaled yesterday that it had to be bought at the fib level here. So again, if I just, I'm just going to sort of blow this up a little bit, zoom out a little bit. Oil doing quite well. Again, it's sort of a just on the idea, there is still maybe a 5 or 10% chance of the US attacking Iran. But really, I think it's more of a sense that, the market in general is rewarding hard assets. So that's, the precious metals and the commodities are doing quite well. And we just look from a technical perspective here, where are we? I'll just put it on the fib. You can see here that, more or less coming into the 50% fib level, coming into the 50% moving average that held. So at this point, this is quite strong, because we could say oil, despite the fact that it is trying to push out, it has held the 50-day EMA more or less for the last 3 or 4 trading sessions. It's now starting to push a little bit higher. So what we can see here is that just on a measured move, obviously, we've got this a pretty important level here at 62.35. But what I would say is that if we look on a Fibonacci extension, we can see that that measures out as a potential goal. You can see that the first kind of fib level, the 618 extension, is somewhere around those recent highs of about 62.35. So that's going to be interesting to see if we get up there. In the meantime, though, the first immediate barrier, you can see here this thick sort of deep orange line is the 200-day EMA. So that's going to be the immediate barrier. Let's look there. There could be a little bit of a reversal there, or at least a little bit of sideways consolidation, 60 and a half, $60.50. That's the first one. But once we get past that, if we get past that, and again, I'll just show you what you need to be looking out for here, is just on the oil chart, is again, that level you see, it's a key level there, $60.50, 200-day exponential moving average, and also the Fibonacci retrace level. But if the bulls can get it past there, that's going to be quite positive. The next hurdle will be the 61.8 fib retracement at 60, let's call it $61. That's going to be the next level. So there's a series of hurdles for oil, but if we can get past these next two, then for sure it looks to me like it may have a shot at retesting up towards those recent highs of about 62.30 or something like that. Obviously, another sort of in the energy space going crazy, kaboom in that gas. Now, a lot of this is weather. It's a combination, as I was saying yesterday, there's a huge Arctic blast coming down through Canada and then into the continental US. That obviously means more heating days, which is a positive for nat gas. So a lot of this crazy move is just because of the weather. The short-term weather forecasts over the next sort of 5 to 10 days have been revised much, much, much colder. So that is positive for nat gas. Of course, nat gas loves a high usage of heating. But we're getting some short squeezing here, and obviously all of these stops are being run. Look at this beautiful technical breakout. Now, is this sustainable? I don't know. But what I can tell you is that this is a very key level here. It's kind of a quadruple top for the front contract at about 4.95. So that's the key level. Obviously having a bit of a pullback here. Now, is this a sustained move? I'm not sure about that. What I can say is that if we look at a fib, the next key test for the bulls is going to be you can see that there's plenty of room here. So the bulls, there's plenty of room, even because of such a crazy move. Even a move all the way back down to 4.2 would do no technical damage to the chart. Basically, we can get that down to about 4.2, which would coincide with the 38% fib retracement. As I say, absolutely no problem for it to come down there. That's going to be the next key level. I'm going to be honest and say I don't know what's going to happen today. It wouldn't surprise me if there's a lot of profit taking and it drifts back down. But that's the level I'll be looking at, is about 4.2, which is that 38.8 fib retracement level. Also, just want to have a look over in the metals. Boom, gold again. I keep on saying boom, but it is true. Gold, another huge breakout candle here. Now, people saying it's parabolic, but as I was pointing out on yesterday's charts, which are still up, if you look at some of these short-term moving average, so the Fibonacci moves here, you can see that some of the fib levels have been reached, but we're still not at that nice big juicy round number of 5,000. And on the longer term Fibonacci extensions, one could argue that, there's technically a little bit more room to go. But are we overextended? Yeah, obviously we're overextended in terms of stochastics and whatnot. If we just throw on some, like, let's say the RSI, whatever, you can see that we're, overbought rather at 77. But could we go a little bit higher? Yes, we could. Now, generally speaking, when we do get to these extreme levels, into the late 70s and 80s in the RSI, what happens? We do get sell-off. So you do see here we had a sell-off. Here we had a big sell-off. So is that possible? Absolutely, that is possible. If we look at Bollinger Bands and whatnot, we're starting to get to the top levels of those. And if I look at the Bollinger Bands as well, you can see that we're well outside the Bollinger Bands. We're obviously overextended on the RSI. So can we get a short-term pullback? Absolutely. But as I said at the beginning of the video, the big kind of macro factors are still there. And just as recently as yesterday, for example, talking about these big macro factors for demand, we had the Polish central bank, the Central Bank of Poland, announcing that they were looking to buy another 140 tons, not ounces or grams, tons of gold. So that's the Polish central bank saying that they still want to buy more gold. If you look actually at the reserves of gold in the world's central banks, they're still very small compared to US dollars and US treasuries. So the point being that, as long as central banks still keep on saying they want to be buying hundreds of tons of gold, I do believe this can keep on going for a little bit. Now, obviously, it's difficult to get in here, but it'd be interesting to get some kind of pullback to, let's say, 4,600. That'd be an interesting level. But for sure, you can't be buying up here. Can you be shorting? Yeah, maybe some kind of long put spread. It could be interesting. Similar kind of situation with silver. Again, I'm not going to say boom. Not quite as explosive. And you see here that silver is starting to show just a little bit of a slowdown. You see on the Bollinger Bands here, not quite as much. It's still overbought. But what I want to just show here is that the gold-silver ratio, which has been plummeting. I'll just give a bit of historical perspective here, and I'll get rid of these Bollinger Bands. Just put it on the white page here. So you can see here that the gold-silver ratio, you see here, this is the ratio of the gold price to the silver price. You can see that's been tumbling basically since, for the last 6 months or so. You can see that that's getting very, very extreme on a historical level in favor of silver. So the silver's outperformance. And what is interesting is that over the last few days, we're starting to see, if we just throw in a few moving averages here, we're starting to see a little bit of stabilization. So, of course, the moving averages are all very strong, but you can start to see a little bit of consolidation around about the 60 level, and you're starting to see here around about the 50 level, a little bit of consolidation. Point being, are we starting to see that gold could start to outperform silver a little bit, and that could just cool off the silver market a little bit. So let's just keep an eye on the gold-silver ratio, because that does seem as though it is calming down a little bit. We can also have a quick look here at platinum and palladium, the other precious metals, also doing quite well, but not quite as well as gold. So that could be a little bit of geopolitical risk as well. Just finally, just wanted to have a quick look at BTC, just from or actually just on the metals. You see that copper, again, not keeping up with the other precious metals, so not really coming to the party as much. Still not doing anything particularly bad. It's down at the 50% retracement for Fibs, hanging in there. Probably just wants to see what Trump, by the way, is speaking today at Davos at 8:30 Eastern time. So that's going to be very important. Trump's speech. He was a little rambling yesterday at his press conference. Doesn't seem to be backing down too much on Greenland, although there was a tweet yesterday which seemed to be more conciliatory. But the point is that I think copper is just waiting to see if Trump sort of tones down things. And who knows, if we start to get a bit of risk on, we have some more earnings coming up over the next week or two or three, obviously. If we continue to get relatively good earnings, Trump, takes down the temperature of the geopolitical drama, no more interventions in Iran or Venezuela or whatever, we could see copper having a bit of a push higher. Just finally, guys, to close, want to look at BTC. As I signaled yesterday, really, the key level, in my technical opinion, just from a technical perspective, is about this 86.75 level down here. You see yesterday tried to have a little bit of a bounce, not doing a huge amount. I think, honestly, if we look at, again, just looking at the EMA, is pretty simple here. You can see here that, overall the 200 and the 100, flat, but sort of trending in a slightly heavy downwards way. I think really what BTC needs is just to get back down here in the mid 80s, 85, 86, around to some of these levels. Who knows, maybe run some stops down here, and then we can go in and test a little bit higher at the moment. We shall see. That's just from a purely technical perspective. Okay, guys, I'm going to leave it there. Have a great day. As I say, probably quite important to listen to what our dear friend Donald Trump has to say at 8:30 from Davos. Is he going to ratchet up the tension with the Europeans, with Greenland, maybe other things? And let's also see what he has to say about tariffs, because remember at this point he was threatening 10 and 25% extra tariffs on Europe, apart from the 200% tariff on champagne, which is actually probably of greater importance for us. Okay, have a great day, have a great sort of week, and I'll be back tomorrow with the macro snapshot from the macro shop. Thank you.